Good afternoon, everybody. Welcome to your Thursday edition of Trader Merlin. Another oddball day. One trade, actually, more than one trade for me today. One actual shorter term trade, and then a protection position for one of my positions is getting away from me a little bit. And we'll talk about that as we progress today. Rainy, gloomy Thursday. Not rainy here, but just gloomy here in SoCal. Is it raining up there in NorCal? Get some snow in the mountains there, Jimmy? I'm going to start off with just by going straight into the data here. Thursday's great data, and the only reason I bring this up is I feel like I'm turning into Jerome Powell. I'm becoming gray. I'm becoming senile. No, I feel like I'm becoming Jerome Powell because my mindset is now shifting to this data dependent. So a lot of the trades that I'm looking at, I feel comfortable with, but all of a sudden I'll look at those trades and go, okay, great. I feel like they could move up for the next week or so based off current trends. And then something happens and immediately that trend is broken and it goes the opposite direction. So kind of wild the way the markets are operating. So I'm looking at data and trying to gauge, what the sentiment is, how markets may move. And then again, because of the tariff talks and all that stuff, it could change in a heartbeat. And of course, next, the Wednesday, right? Wednesday's the 2nd, 31st is Monday 1st. So Wednesday, we do get the tariff ultimatum laydown, and we'll see what that actually is here and talk about that in a second. But let me show you the data here, just to start off with. We had GDP expectations that we're going to stay right at 2.3%. Now, we actually came out at a higher clip at 2.4%. And this is important because when you look at the annualized number here, we had this last little piece drop off. So slightly, I would say slightly higher than expectations. Nothing fantastic. Obviously, we'd like to be above 3% would be even better. But the good news is positive beat, GDP looking better. And of course, I don't believe that we're really seeing any of the trade talk stuff hit this yet. It'll probably be next quarter where we really start to see the impacts of this if it all gets implemented in an aggressive way. Hello, Elaine. Good to see you. So GDP is great, at least from a growth perspective, but I do believe that that's probably 3 months old worth of data, not the current stuff since really January. I don't think it's really taken into effect the actions by the president yet. So while it looks great on paper now, what's the next two readings of GDP going to be? Now, you guys understand that there's 3 different readings of GDP. There's advanced, there's preliminary, and then there's final. So by the time we get to today's number, we pretty much know what GDP is going to be. That's why it was surprising to see it jump to 2.4 versus 2.3%. In another month, or actually in another 2 weeks, we will get the advanced GDP number, and then we'll get the preliminary, and then we'll get the final. So they're kind of revisions of each other as they go, but giving you an idea of where things stand. Now, the other part we've been talking about for the past week and a half, 2 weeks, has been housing, the importance of the housing sector. I was having a conversation with a friend of mine a couple days ago, and we're looking in the neighborhood where I live, and not one home for sale. There's one home was put up for sale, literally had multiple offers that night because I talked to the realtor, and sold immediately. So we have a really hot housing market where I live. Thank you very much. Knock on wood. That's a good thing. But the housing market seems to have cooled a little bit in other areas. We looked at the Case-Shiller Composite 20 Home Price Index a couple days ago. That looked better. But what about pending home sales? This is pretty important. This is sales in the pipeline. And these numbers have not looked very good. For January and February, we had a significant decline in pending home sales. I do believe that had a lot to do with the higher number for the 10-year, right? If you go back a few months, let's go look at the chart here of the 10-year bond just so we can kind of see what that looks like. Back in here in January and February, we had much higher yields. Now, all of a sudden, our March number, or the next number that's going to come through for pending home sales, starting to look much better. Why? Because money's cheaper, people can qualify for these loans, and more home transactions going through. So this is another great piece of data. And this is a multiple data point. The reason I say multiple data point, obviously you want to have housing sales increase, right? It drives the value of homes up. Now, if you're renting, I'm sorry, this is not a good thing for you. But if you are a homeowner, this is a great thing for you. You want to see demand for houses that pushes price up. So that on its surface value benefits those who are homeowners. Hurts you renters, my apologies. On another level, what it does is it actually helps from a spending perspective, because as property values appreciate, typically people have access to more credit. They can pull loans against their home, they can refinance and get more money and more capital and go spend and buy more stuff, which drives the consumption wheel of America and keeps pushing things higher and higher and higher. So I put Thursday's great data because I kind of feel like this is a pretty important one that a lot of people downplay. They don't really look at the impact of housing and what that might mean for the economy going forward. But really today, two pretty darn good pieces of data coming out for our equity markets with the GDP numbers and your pending home sales. Now we could talk about the trade balance. Our trade balance has always been negative. Actually, I don't know. Let's see if I can go back and find any spot, at least not over the last decade, where we've actually had a surplus of trade, which means we are importing far more than we are exporting. And I think it's kind of interesting how you look at the last two readings of this one, which is some of the worst trade deficits we've ever had in the history of the United States. The previous number here for February, we had a trade deficit of 153 billion. And for the month of March, that dropped a little bit to 147. So worse than expectations. We thought it'd be 134. Not good. Now, I don't know if this is going to fix itself with tariffs. Most likely it will not. But we will probably import a lot less stuff because of the tariffs. And we could see, if the tariff talk implementation does go through, which of course will be April 2nd, we may see over the next 4 or 5 months, I'll kind of scale this out here, we may see this start to shift and drift back up. Certainly, I don't think that there's a hope in hell that we're going to get to zero here, but do we start to close that gap? Meaning, instead of spending money on foreign countries' goods and services, that money may be coming back into domestic consumption, which should drive the economy. And again, this is all, I will say, purely speculation on my part, right? I'm coming up with this hypothesis of what I believe. Some of you may completely disagree with me, and I'm okay with that. Type in a chat, what you think the impacts of this is going to be. For you and I, obviously, I like doing the show every day, but ultimately my trade plan is based off of my talk track that I share with you. Many of you are going to have a different idea of where the economy is going or different perspectives on how Trump may influence beneficially or detrimentally the economy. And of course, you have to put your money where you believe it's going to work the best for you. So I'm just giving you a little idea as to where I think things are headed. Again, I could be completely wrong here. And ultimately, I'll have my money on the line when I make these trades. And I'll let you know what those are. We are a nation of consumption 10 times more than any other. I know, Steve. We are a consumption economy. And the reason I brought that chart up is if we look at GDP, for example, let's see, that was not the one I was looking at. I was looking at the trade deficit. Let me bring that trade deficit back up here. Where did that number disappear on me? The goods trades balance. So in this chart here, it clearly tells you that we are bringing in way more than we are sending out, right? Our imports are way higher than our exports. Now, if the trade tariffs do get implemented here and continue to hurt import activity from a cost perspective, it's my belief that will drive more domestic production and domestic consumption. I think that ultimately is the idea of President Trump and the administration, as well as that by putting all these tariffs on, international steel, reciprocal tariffs, you have it on aluminum, you're going to put 25% tariff on cars, that will make a vehicle coming from China or from Germany or from Mexico more expensive, and therefore you're probably going to go buy something that was made in America, which, hey, I'm all for that. I'm all for buying America and supporting our country as opposed to supporting another country. I just think that is a level of patriotism we should all have, as long as the quality of the goods and services that I'm getting domestically are equal to what I would get somewhere else. Now, we all have opinions of Chinese quality, but if a Chinese car like the Li Motors or BYD Motors vehicle, which has amazing technology, is far superior than what Tesla or U.S. automakers are making, I might even pay 25% more with those tariffs. All right, let me see what you guys said. It's because nobody's buying cars now. It's funny because Jeff Mackey, who I've mentioned here before, used to be on Yahoo Finance, he posted today that he's looking to buy a new car. Should he do it today, right now, or wait 30 days? And I'm like, my comment to him was just how I live my life is, it's a question of needs versus wants. Do you really need a new car right now? Personally, I think you should just ride your car into the ground. It's paid for, just get the most out of it. You don't need to take on any new debt. I'd much rather take the money I would buy a new car with, put that into an investment account, and continue to grow at a rate that beats the rate of inflation and grows my capital. But that's just my mindset. Many people are different in their needs. Anyway, do you wait? So that shifts the conversation here a little bit. Let me, that's not where I wanted to go with this. Let's see. Let's see. Trump will approve it, which will help GDP and jobs. We are a nation of consumption. Yep. Companies are anticipating tariff implementation. And that's the key, Andres. That is the key right now. When you look at it, this guy right here, he's talking tough. However, most of you remember or should remember what happened in his previous administration. This was the norm. He would talk tough. He would lay down the law. He would shock China. He would shock other countries with, we're going to slam you with these kind of tariffs. And all of a sudden, it would be a significant backpedal at the deadline. So right now, based off what's happening, I think the markets are going back into panic mode because it sounds like Trump is going to play hardball by next Tuesday or by Wednesday. History kind of makes me believe that come Wednesday, he'll step back again or give it another reprieve. Remember, some of these have been reprieves. The tariffs on Canada, the tariffs on Mexico. Oh, we'll give you another 30 days. Or we'll hold on until this happens, right? You keep threatening, but you don't act. It's like two guys standing there in a fight. Well, go ahead, throw a punch. Go ahead. You start pushing and shoving, but no one actually throws a punch. Until that first punch is really thrown, the markets are going to have that uncertainty. And I think when that first punch does get thrown, if we do in fact get all these tariffs on Wednesday, I would expect the markets to have some more downside movement, which would make me upset because I closed out my short position on SPY because I was underwater on that one. And of course, as soon as I got out of that one, we had a nice big down day. So just the nature of the beast here. But if those tariffs do come into effect, I think we'll be challenging these lows on the S&P 500, which is right around 5,509. And I think we'll probably break those even more. But you guys had a lot to talk about. Oop, there's the chart right there. You guys had a lot to talk about on that one. 99% of all the world's wealth leads to buying everything. Yep. Consumption and services, 52% of General Motors vehicles are made overseas compared to Ford's 78. Yeah, no, I saw that. And I actually created a graphic for that one today because I thought, if you look at GM's chart and Ford, which we'll do here in just a second, on paper, I think most people, the average American, is going to look at this news and go, this is great for Ford, it's great for GM, this is great for American automakers. Let's bring it back to America. A lot of their vehicles are made overseas, or not overseas, but outside of the U.S. borders, which they may not feel the full brunt of these tariffs, but they certainly will feel some. If they have cars being made in Mexico that are being brought over the border, 25% tax right away. Apparently that is due to be collected April 3rd. So it goes into effect April 2nd, start collecting on April 3rd. Now, you can see here by looking at some of the automotive charts. Look at the chart today of General Motors. You had a 7.36% slide today in GM. I think that people are just, much clearer in realizing that a lot of their vehicles are made across borders. I can't verify Noam's numbers, but I'll trust you, Noam, on that one, where you said 52% of GM's vehicles are made overseas compared to Ford's 78. Really? Ford's 78%? Well, Ford also had a pretty big down day today, 3.88%, getting down there at $9.90. Yeah. And Naum says Tesla is 100% American. Well, the Teslas made in America are 100%. Right, Tesla also has factories in China, which are making Teslas as well. But yeah, Tesla was actually okay today, up 0.39% to $273. So not feeling as bad as some of the domestic auto manufacturers. But yeah, I'm definitely. It's interesting. You look at what's going on with Tesla and all the hate and backlash to Tesla. It's like, wait a minute, we're the ones building 100% of our vehicles in the U.S. You should be supporting us. Oh, the drama is crazy. Margaret says, built here, but the components are probably built in Mexico or elsewhere. Right. And that probably will be the next step. The next step's going to be, well, where are they getting the components from? Oh, you're getting your components from China? Okay, well, that's going to be a reciprocal tariff, and now we're going to tariff that 30%. So this is, as I've mentioned every day, it feels like, and I apologize at the sake of sounding redundant, but I do think this is the new norm. I don't think this is going to change anytime soon. It's going to continue to have more and more shock waves as Trump continues his tough talk with international markets. So I mentioned on yesterday's show, or the day before yesterday, that I'm scaling back a little bit on my exposure. So I have a couple larger positions cost-wise, but I have a lot of free capital, and I'm like, I'm just going to not go heavy right now just because that uncertainty is making me a little bit too nervous. And it feels like one day markets are like rejoicing and positive, and the next day the sky is falling with very little transition period. That makes it hard. That really makes it hard for me. Are most batteries built in China? I don't know, Margaret. I would assume so. You know, didn't Tesla and Samsung do the giant gigafactory in the U.S.? So there might be some production here, but I do believe most of it's in China, but I can't definitively give you an answer to that one. Let's see. Kind of funny. He said that all the trade deals are horrible. He's the one that negotiated the last trade deal with Mexico and Canada. Yeah. Well, it's not his fault. If something works, he'll take credit for it. If it doesn't work, it wasn't me. No one knows it like I do. It was someone else that did that. Let's see. What did Dwight say? Do we have the capability to build all the things we consume as a country? Yes. To Steve's answer there, he says, we have the capability, Dwight, but it's significantly more expensive due to labor costs. Yes. 100% correct there. We definitely have the ability to make every piece of that car, 100% of the car components in America. However, the electronic components would be much more expensive here to manufacture. Therefore, you know, your Ford, let's say your Ford F-150, I don't know, I'm throwing a number out here, but let's say it's $35,000, $40,000 for an F-150. If all of those components were made in the U.S. and all of the assembly was made in the U.S., remember, I can go to Mexico and get labor that's probably half the cost, and I don't have all the benefits and health insurance and all that stuff and unionized automotive workers. My labor costs are much higher in the States. So if everything is fully manufactured in the States, I would imagine the cost of that vehicle goes up probably by more than 25%. So it's going to be this interesting chess game that plays out. I guess the question which I have received is, you know, what are your thoughts on buying Ford and GM because of that? I'm out. I don't. First off, if you look at the Ford chart here, which has just been drifting lower and lower year after year, really since 2022 when it peaked at over, you know, $25. You know, here we are at $9.90. So I don't really like this chart at all. Now, you guys would know Michael Anthony, who I haven't seen him in a while, but I'd get a message from him on Sirius. You know, this is the type of chart that Michael would be looking at because it's just going lower and lower. And at some point, people feel like this is going to be a screaming buy. And maybe Ford does become a good buy here. But for me, it's a no. You'll notice that from my strategy, the way that I approach the markets, I would be looking at these highs that formed over the past couple months on Ford right around $10.50, which we tapped into today. Today's high was $10.40. I would argue that if we get above $10.50, then that would probably be the first indication that I'm looking to buy, right? I'm not going to buy this until it starts to make some new highs at least. The other negative part here is it does feel like it's been consistently making lower lows. So I haven't really felt like it's based yet. So no, I am out on Ford. What about General Motors? A way better chart. At least from, you know, late 2023, you've had this really nice move to the upside. We actually drew a downward channel on this one a while back. I don't remember when we did this, but we drew a downward channel on it saying, hey, it's making lower lows and lower highs. The good news for anybody looking at GM is it did break out of this channel. However, it gapped down huge today and is right back in that channel to the downside. So it's a no for me on going long GM or Ford. Unfortunately, you know, nothing against the companies. I'm just looking for opportunity and value. It gapped down today because I believe that a lot of the focus is now on these auto tariffs and the realization that a lot of their production is international. So they are going to feel the tariffs. Now, as a consumer, I'm curious what's going to happen, right? If I'm in the market for a new car, and let's say I really need a new car, I would probably buy one by Tuesday. Now, here's the interesting, and this is how my mind thinks. So sometimes I could be a bit of a conspiracy theorist. Maybe this is all wild talk to get people rushing to the dealers to buy cars. Because if you're an American right now, you're pretty sure that the cost of your vehicles are going to be going up. I'm hearing numbers that the average cost of a car is going to rise from $5,000 to $20,000 depending on the vehicle. So why not buy it today? So we create this frenzy up until April 2nd. Got to get a car, I want to save because it's going to be expensive on April 3rd. And we backpedal and don't do the tariffs. Just my conspiracy theorist belief that this is all part of some big game being played. So who knows? Let's see. And he's happy to take, of course, we will need to find more laborers to work. So Steve, here's the other side of that. If you're looking at Ford and GM, while I agree with you, we may need some new laborers. I do think that if they were to rebuild factories today and make new production facilities, which of course would take a while to build, that they would be predominantly robotic. So yes, there would be some hiring, but nowhere near what they were in the classical days of, old Detroit with factories full of thousands of workers. I think those days are dead and gone. It'll be mainly automated and robotic facilities with human involvement to make sure that things are running smoothly. So yeah, we will need some labor, but not the mass numbers we did before. Volvo is going to get clobbered importing their cars here. Volvo, BMW, Porsche, Ferrari. I think what Ferrari just said, they're going to add a 10%, they're going to increase their price 10% anyway. But even with the tariffs, like, okay. But look, for the people that drive Ferraris, whatever, 10, 25% more, it doesn't matter. It's the average American, not the elite American who's making millions of dollars per year. Mercedes as well. Yeah, some of the best cars in the world are German. Great machines. I was born in Germany and I still won't own one, but I guess I would own a Porsche, but not really a Mercedes fan. But we've had this conversation before. I want the best bang for my buck. I want something that gets me from point A to point B as most reliably as possible. And my car does break, I want to make sure that it is inexpensive to repair, which is why I've been a Toyota guy most of my life. And yes, my Toyota costs might start to increase if those cars are made outside of U.S. borders. Now, some car companies are manufacturing in the U.S., so maybe I'll do a special on all the different companies and what percentage of the vehicles are manufactured in each state. We'll probably try to do that by Tuesday. Let's see. Liz says, but if the new foreign-made cars are already sitting at the dealer, would that be exempt from tariffs? I guess the question is, at what time does the tariff get applied? Great question. That I don't know. My assumption would be that it would be a retroactive thing. If you purchase that vehicle internationally and it's now sitting on your lot here, that one now has to pay 25% more. I would assume that's the route, but I have no idea. I've not dove into that. And from the stuff I have read on the tariff talk, there is a lot of ambiguity. There is a lot of, I'm not quite sure what tariffs are going to be impacted where, which part of the automotive industry gets hit. Is it parts? Is it full vehicles? Are there any exemptions here? We'll find out when we get to Tuesday's announcement, which really I think is going to be a crazy day for the market, whether he says he's going to do the things or not. Now remember, what happens on Tuesday? Tuesday, we get 25 on Canada, 25 on Mexico. Tuesday, we also get the reciprocal tariffs if needed. And there may be other tariffs on India and Thailand and pretty much any other country out there. There is a potential for other tariffs to be imposed there. I had a whole document that I made earlier today, but it's downstairs of all of the areas that tariffs are going to start to jump in here. Of course, 25% for vehicles manufactured outside of the U.S. And who knows if something else gets thrown into that mix, but it's coming. That finish line's right there. The question is, do we move that goal? Now, let me see. I'm going to do a poll here just because why not? I can do a poll. Start a poll. It's hit Wednesday. I'm going to put, will tariffs hit yes or no? And kick the can out of the mouth. There we go. Here's my poll. Hopefully I didn't type anything too incorrect. When I type fast and talk, will tariffs hit Wednesday? Yes, no, kick the can another month. I guess that's part of the no category there, but that's my question to you. We need to see who's lobbying the White House to know who will suffer from the tariffs. Yeah. Oh, the other one was copper. Right? We talked about copper and stockpiling copper and how copper has moved up so much over the past few months, given its crucial uses in society. Let's go look at that copper chart. We're down 2.36% today. Oh, mamma mia. You guys know my favorite pattern out there is a shooting star, right? You all know that. Look at that pattern from yesterday on copper. Oh, what a gorgeous selling opportunity. And my rules too. My rules are it's got to open up above that red line. And then once it crosses, there's your short opportunity. What a gorgeous short trade on copper today. I hope that someone took that one. Jeez Louise. Yeah. Freeport McMoran. Woo. Yeah, the bearish engulfing pattern followed by a runaway gap. Ooh, that is really ugly. Now, percentage-wise, it's not that bad on Freeport McMoran, right? If you look at the absolute peak to where we were closed at today, it's 8% in 2 trading sessions. Granted, that's bad, but not screaming bad. There's another thought. If tariffs do go ahead, does that mean the used car market will rocket? Yeah. And great question, Liz. And maybe that's why we're seeing Carvana you know, at lofty valuations. Now, again, they've sold off dramatically from that peak we had back here in February. But I would think that if you're going to, look, if you're going to get a car, you should buy a used car anyway. And that may drive up those prices of used cars, absolutely. AutoZone's one of the most beautiful charts out there. AZO. Remember, we talked about why this one looks so incredible. It's up 3.98% today, $3,828 per share. I mean, that is, I could make the argument this is sexier than NVIDIA, just because it doesn't have the crazy fluctuations. For the podcasters out there, and apologies, I'll try to read charts as we go. If you go back into 2017, AutoZone, AZO, was trading at $492. As of today, you go to its peak today. Let me scroll over here so I can get the exact number. As of its peak today, it's right at $3,828, which I can't even get the dead peak of this one, unfortunately. It looks about 682% rate of return. That is crazy number. Let me get exact. There we go. So yeah, 678% rate of return on this one. And it's kind of weird because it's showing, oh, that's how much it's gone up. Yeah, 3,828. Pretty phenomenal gain. 678% in that window of time. And if I were to put, let's say, just for fun, let's throw on NVIDIA, which has been this super darling stock. Okay, there's your, nope, that's not what I wanted. It put, oh, there's NVIDIA. So NVIDIA's got a way better rate of return. But NVIDIA is so choppy and erratic, it's all over the place. AutoZone is just beautiful, consistent, always going up. All right. That was a thought from my hubby. He suggested Carvana just before you read my comment. Yeah, the only problem, or not the only problem, but one of the big problems I have with that, Liz, is Carvana. Big Ed brought up the PE ratio last time we really had a discussion on Carvana, and its PE ratio is off the chart. And I don't know enough about the fundamentals, CVNA. I don't know the fundamentals well enough to look at this and say, yeah, it's a good deal right now. Granted, off of its all-time high from back here in February, you're currently sitting at a 30% discount. But fundamentally, all right, let's go look at some of the fundamentals here, the financials. It's got a PE ratio of trailing 12 months of 140. Remember, the average PE ratio for the S&P 500 going back in the 1950s is like 18 to 20. 20 being the high end of the range. So this is, 7 times higher than the average stock on the S&P 500. To me, I would see that as a red flag. I would think that that is not a good thing to see a PE ratio that high. And it's not like this is a tech firm, right? This is not NVIDIA. This is not Apple or Amazon. This is a car company. They got little vending machine towers on the side of the roads. Which one you like better, S&P 500 or VOO long term? So I'm mixed on that one. I would say probably VOO just because the annual cost is cheaper. I like SPY. It's always been one that I like just because of liquidity and I'm just used to it. But technically, VOO has slightly cheaper fee structure than SPY. What's the deal with AppLovin? So let me go into AppLovin here real quick. There you go. As Big Eb said, SPY for trading, VOO for investing. Yeah, and then for the long haul, yeah, it's the fees that are going to make a difference. Short term, you've got the best liquidity you can get on SPY. Let's go to a question that came in from one of the viewers out here, and that was about a pattern called a bear flag. So I asked my AI to create a little graphic for me. I said, give me a bear flag, and that's what it came up with. Not the best. It has a flag with the word flag and then a bear looking kind of cute there. The question was from Michael G. He says, is the AppLovin chart a good example of a bear flag formation? How do you think this plays out? So let's go to AppLovin. AppLovin. This is not AppLovin. This is Pain. So going from its peak from February 13th to where we closed at today, AppLovin is down 50% in 29 trading sessions. Brutal. Now, is it over? I don't think so. If you look at this chart, AppLovin had a pretty phenomenal run. I mean, literally back here in 2022, AppLovin was trading at $9, and it hit a high of 500. So clearly something was going on there, manipulated, maybe creative accounting. There are several different companies out there that issue short reports, right? There's these firms out there that all they're doing is gunning for a company, typically something that's gone parabolic or the numbers just don't make sense. And then they start to flood the market with all this supporting information on how bad it is, on how this is going to crash, it's a fraud, you've got to short it. And they build big short positions on it. That's what's going on with AppLovin right now. What's the name of the firm? There was a company out there, I forgot what the name of it is, but they're typically Muddy Waters. So Muddy Waters is talking bad about them, big short position, and I think that's starting to create a little bit of panic on the part of AppLovin, because honestly, I think it's gone up just way too much. Know what they are? Yeah, there you go, Muddy Waters. If you look at the chart, honestly, I've got two little lines I'm going to put on the screen here. And for the people that are listening to the podcast, you've got a pretty crazy chart. I mean, it is the gap up that happened on November 6th. It jumped from roughly $174 on their earnings announcement. It jumped up the next day to about $228. It really hasn't looked back since then. It went from $228 in November of last year to $520 back in February of this year. And then it just started to fall apart. So the concern I have for anyone who's looking at AppLovin is Hindenburg was a big one, but I think Hindenburg has now shut their doors. Yeah. 228 is that line in the sand. So if you're looking to buy AppLovin, 228 would be a decent spot. But remember, if we close below 228, that gap is going to fill. At least I think so, right? Based off of just typical technical analysis. That gap goes all the way from 228 down to 175. So you're talking a 53 point potential drop once we get below 228. To me, not worth it trying to catch that falling knife. I don't know hide nor hair about AppLovin's corporation or their business, but I would be very careful with this one. For sure, if you're looking at trading options on this, the premiums are going to be off the chart just because of the uncertainty and unknown. Its average volume, at least for the past couple weeks, has been decent. Several million, that's fine. Today, traded 20 million shares. Going back to these low periods here, it's trading 3-4 million shares a day. Plenty liquid overall, so that's not a concern. But big volume on today's action. I wouldn't touch it. It's just a little too wild for me. And then let's talk about that one. So Margaret says, let's see. I want to make sure I answer this question from Michael G. Is it an example of a bear flag formation? Okay, great. Let me answer that one. In my opinion, yes, this is an example of a bear flag, and I'm going to draw it for you. It's not today. It's what happened here. So from its peak on February 13th to its bottom on March 10th of this year, so just 16 trading sessions, this stock fell 55%. Then it had this little channel back up, right? And I'll just put some lines on here to roughly get that channel in there. Right about there, I would say, is that line. And then we can put one across the bottom here. And you have that, right? So there's your pole. And remember, the pole has to be like an outlying move. It can't be something that's just super simple and barely trends. It's got to be an aggressive, really aggressive move. And that's what you saw here in that 16 trading sessions was a 55% drop. I think you'd all agree. I don't care what it is you're looking at. If you have a 55% drop in something in a period of 16 days, that's like a Macaulay Culkin, oh my God kind of moment, right? Well, in this move up here, let me just see how much it's moved up. It moved up a total of 50% in 11 days, and that was that flag. That was that retracement, if you will. And typically for a bear flag, it's a very sharp, aggressive move down, and then you have this kind of consolidation where it moves the opposite direction, but not as fast. Now, it certainly did move quickly, but not as fast as it did when it sold off. So really what you're waiting for is that break, and you got the break today. So there is your break of the bearish flag formation. So Michael G, yes, I would say that was a bear flag. And now, if you are going off of pure technicals, right, if you're the technician type of person, this is going to scare anybody who's looking to buy APP. The way the bear flag typically works is you take the pole, which we've already talked about, that 16-day window, and you move it to where it broke down from. If it broke there, that means that the target, based off of this, is $35.43. I'm going to move this line to exactly that number. Let's go text, coordinates. We'll put this at 35. I think it's at 35.43. Hit OK. Let me just make sure. 35.43. And I'm going to put on there bear flag target. Oops. Let me go put on the text on the screen, right? Bear flag target. Just so we have that on the page. Now, that would be a crazy sell-off. That would be from the breakout, a fall of 89%. But that's typically how you use a measuring object on something like a bear flag. Now, that's a bear flag. You could also do bull flag, which is the exact same thing, just the opposite way. So, Michael, thanks for the question. I hope I answered that one to your liking. That's how I look at it. Let's see. What was the question that came through? What happened to GameStop today? Yeah. What happened to GME? You know my take on it. Even though they're saying they're going to buy Bitcoin, I still say leave it alone. Leave it alone. Okay? So let's look at GME. And you're like, well, Merlin, they say they're going to be buying Bitcoin. That should be good because it worked for MicroStrategy. Why is GameStop tanking like this? Well, remember, they had almost $5 billion in cash. So what they should be doing is taking some of that free cash and buying Bitcoin with that. Instead, I feel like they're playing shenanigans with their investors, because what they're doing is they're going to issue a 0% interest convertible bond. They're going to sell $1 billion worth of these convertible bonds with zero coupon payment, and with the expectations that you can convert it back for GameStop's shares at a later date. I think a lot of people look at that going, why would I do that? Why would I ever want to buy GameStop's bonds and get 0% premium when I can go buy MicroStrategy's preferred shares and get paid 8% in perpetuity forever, right? If you have those two things side by side, it's like you're kind of a fool to buy GameStops. And I think that's what it essentially was today, as a lot of people were like, why would I buy GameStop? There's no big benefit here for any investor to go buy these bonds from GameStop. The convertibility ratio just isn't good. And I didn't see the exact number, but it's GameStop. It's GameStop. Why would you want to buy GameStop? Anyway, I think that's the main reason you saw it. Was I think the industry kind of felt slighted by it. You're right back to those lows we were like 2 weeks ago. And that's what you get for buying GameStop. GameStop's trash, period. Now, I like the fact that they're talking about buying Bitcoin, but the way they're going about it was wrong. I think that's really what lost the confidence of investors, and that caused them to just come crashing back down. Isn't that a lose-lose, huh? Own GameStop and you get nowhere? Exactly, Steve. Well, I didn't see the conversion numbers, but typically what it will be is you get to buy it at a discount. And the assumption is that GameStop buys enough Bitcoin that drives their share price up to, let's say, $40, and you get to buy it at $30. So there's that premium that you would receive. And MicroStrategy did this as well. They did some zero coupons, but now I think the market and the industry is demanding some rate of return in that process. Is that an island reversal? That it is. Oh, we're doing more pattern recognition today, huh? Yeah, this right here is an island reversal. And the reason you would call it an island reversal is it's all by itself. So you notice it gapped I'll do a yellow box between these two red lines just for a visual perspective. Let me turn the snap off. This yellow area is untouched. So it literally gapped up without touching anything else, and then gapped back down without touching anything else. You have this completely untouched area. That's called an island reversal. And it's interesting because people say, oh, I was going to trade the island reversal. Look, if this was here yesterday, you wouldn't know that this is an island reversal. It's just an island. You don't know it's reversed until it reverses. It's kind of like a double top, right? A double top, you don't know it's a double top till after it's sold off on that second hit. So yes, it's an island reversal, but let's be honest, how actionable is it, right? Is it one of those things when you see that gap up candle, you go, oh, it's going to gap down huge tomorrow? Nope. I watched a trader lose $800,000 in a period of a week shorting something gapped up like that. 800 grand in a week. Crazy. I'd rather put my money on Blockbuster. Irish, I like that. Yeah. And Blockbuster's long gone, too. All right, let's see. I had a couple other questions here. Let me get to these ones, and then we'll wrap up for the day. Scott, as always, thank you very much for your comments and questions. I thought I had a few other questions from you guys, but I looked in my inbox. I did not see as many questions as I thought I was going to get. So if I have not answered your question, email me. Just send them on in at tradermerlin@gmail.com. I'm going to create a separate folder now for all questions. Therefore, I make sure I answer every single one of them because I feel like I've missed some. Scott says, you always talk about wanting to own Tesla, Nvidia, etc. for the long term. Do you have a Buffett-style account where you buy dips and hold stocks for months, if not years? Personally, I have 3 different accounts these days, all with a different style and purpose. Has really helped my trading, being able to easily separate and follow my rules for the different trading styles. So first off, it's great for you, Scott. I've mentioned this before. I think each one of your accounts should have specific objectives, and you should not mix them. I learned this early on when I was a day trader. I had a day trading account, and all of a sudden it's like, oh, you know what? This position looks good. I'm going to take it overnight. And then a gap against me, and now I'm a swing trader. I ruined that style. So I absolutely think you should have, shorter term accounts, but have very specific rules to it. As far as my approach, I do have longer term accounts, but I'm not a Buffett investor that typically holds for years. The only thing I'm holding that long is crypto. That's it. So typically when I buy something, I really enjoy now just collecting the premium, but if I feel really adamant about something, I will buy it, and I'll usually sell calls against it anyway. Even though I think it's going to continue on moving up, I'll sell those calls at a higher price that might be way out of the money, but get myself an extra, 0.5% or 1% per month just by selling a premium. And as happens quite often, you'll get a big surge up and it takes you out, and you go, okay, fine, whatever. I made the money I wanted plus some premium along the way. So that's, I'd like to hear other people's rules someday. You all got to have different rules for different accounts. But Scott, yes, I do have a longer term account. It's more position trading, not really long-term investing. And when I see an opportunity that I like, I'll buy it. I'm not a value play like Buffett. I'm not a Larry. I don't look at the fundamentals. I just look at the price chart and the company itself and think I'm good owning, like NVIDIA. I mentioned selling the 108 puts. I may actually sell some more if we continue to drift a little bit lower. Fine owning at 108, and the premium's getting richer and richer because it's trading at 112 right now, and I've got them for next Friday. Cool, great. The only one that I don't really want to hold long term that I'm in right now is SMCI. I've been playing SMCI in my aggressive options account simply because the premium is so darn good. Right now I'm underwater on that one, pretty good. I had the $40 strikes, and right now it's under 34. Or sorry, it's under 35. Let's go SMCI. In order to protect myself today, I did buy puts this morning as a protective hedge below 35. So I paid an extra 1% for the next few days, actually less than 1%, but I paid premium just to make sure I was protected if this thing breaks below 35. Because you can see on this chart here that SMCI, if it breaks this 35 level, there's actually a little bit further back, if it breaks the 34.51 and closes down below there, you've got a lot of small little unfilled gaps, and this could easily find its way down here to $27. I don't want that. So I hedged myself by hedging my whole position short at a break below 35. So I have 1 day left. It was worth the risk premium to pay just in case this thing does have a big break, because that downgrade by Goldman Sachs doesn't help. Goldman Sachs said their price target is $32. Which is considerably lower than where we are today. So not very good. Am I going to watch the Giants today? Nah. No, I tell you, Oliver, while I'll always be a Giants fan, I don't really follow baseball as much anymore. I probably couldn't even tell you a player on the team now. I just don't follow. It's just too much. And then, I don't like baseball because I feel like there are teams that can just buy themselves the all-star teams. I mean, look at the team in Major League Baseball with the worst fans, the Dodgers. If you look at the Dodgers, they're just out there spending way more. I mean, there should be caps. A team should not be able to spend more than X amount of dollars on their players. And Dodgers, Yankees are just classic for spending way beyond that because they're the A-list teams. They have all this money, and they buy themselves championships. So no, not going to watch the Giants. I mean, maybe if it's on and I'm bored, got nothing to do, yeah, sure, I'll throw the game on, but I'm not going to watch opening day. Not my stuff. Not my style. I'm a Dodgers hater. It's funny because I'll be honest, Oliver, I don't hate the Dodgers. I love talking trash about the Dodgers. I've got a bunch of friends down here who are Dodgers fans, and I love getting them all riled up talking trash. All right, let's see. Here's the results of the poll. Will tariffs hit on Wednesday? 60% of you said yes. 28% of you said kick the can another month, and 11% said no. I think what we will see is a hybrid. I don't think you're going to see all of it implemented. I think he'll backpedal on some of it. Some will get implemented, and we'll start to see that domino effect of how, at least get a clear understanding of what's going to happen. I think that his reputation, his integrity would be damaged if he didn't do tariffs at this point, right? He's been talking about it so much. If he didn't do anything, people are like, oh, you're all talk, you never really do anything. I think he has to do something to save face here and be like, all right, well, I am going to tariff this and make something happen. Let's see, I had one more question. This is from Steve W., who's here with us today. Guten Abend. Mein Freundin. He says, pretty soon, short gold. I think August. What about Basel III? Is it coming? Under 20% on the S&P. Everything is going down. Okay, so you got 3 different questions there. Number 1, and what time we got? Okay, number 1, you asked about shorting gold. I'll tell you what, I'm not shorting gold. Given this climate of uncertainty, given this crazy tariff war talk that's going on, it does look tasty. If this is a normal stock, I would say it's got to be getting towards that short point, right? But I'm not shorting gold. There's no way. If anything, I'll buy a pullback along the way, but I'm not shorting gold. I'll go back to the low here just from November 2024. You have gold's up 20%. And we hit an all-time high today, closed at 3,061, up 1.27%. You say August, maybe, I don't know. I'm not shorting something that's at all-time highs. I'll never short something at all-time highs. To me, it's just too big of a gamble. Now, to your second question about Basel III. Basel III is a set of rules that were put in or are being put in place to address the issues that happened in 2008. Let that sink in. 17 years later, we're all of a sudden getting Basel III put in to say, okay, those issues, we got to make sure that doesn't happen again. It's like, really? We had to wait 18 years for that? Bureaucracy is a horrible, horrible thing. What is it going to do? It's going to add in extra stress tests on banks. It's going to make sure they have certain capital requirements and may constrict banks. I believe in the U.S. it's supposed to implement in July 1st, I think. I'm going back old school, my memory here, but I'm pretty sure it's July is when the rules will be implemented here in the U.S. Now, what does that mean? Well, that means that things like XLF, let me go to my financials here, they may start to see a little bit of downside movement. Why? Because they're going to have higher capital requirements. Their reserve requirements they're limited on what they can do. They want to make sure that the banking system is much more stable. So should there be a financial crisis, our financial system doesn't collapse. So I do think that getting near July, maybe even June, might be a good time to start thinking about shorting financials. Now, that's all hypothesis at this moment in time. When we get there, maybe I'll address that more in June. Today, now that I'm on the topic, I had a trade today, which was a decent one. I've been waiting for 2 days for this. I looked at this supply level on XLE. I know I just transitioned the talk track here real quick, but just because it's on my watch list of S&P sectors, I had this little supply zone mapped out a couple days ago. I'm now doing something every morning with Jeremy Johnson, was one of our video guys on TikTok. I don't post, but Jeremy has me record a video every morning on TikTok, which is what's happening. And 2 days ago, when you go back to the 25th of March, we had a big shooting star right in the overhead supply. They had a shooting star yesterday, and I was waiting for it to break below. So today was a nice little short trade. Not a huge move, but certainly a nice down move on energy. We'll see if that one continues from that overhead supply level. You're double top there. Anyway, to the third part of your question, which was under 20% S&P, everything is going down. No. So here's what I think will happen. Let's just go to the SPY. And I think I've mentioned this before. What will usually happen is here we are off the all-time highs. Let's draw this line right here. And right now, our low point was 10.58%. So let me zoom in here and show where 20% might look like. So I'll go all the way down to 20%. A 20% decline off the all-time high in the S&P puts us roughly, and again, I'm using SPY, at $490. And we're currently at 576. So that would be a long way to go, right? That would be 77 points. Big drop. Once we get to that 20% mark, here's what I think would happen. I think what you would get is you would get a bounce up from there. Let me lock this in here. I think you would get a bounce up. And then I think it'll come back and challenge it. And it'll probably bounce up again. And then it'll break it. It'll retest. And then I think the downward move starts. So I think you get something that looks like this. I know it's hard for the podcasters to see, but basically I'm just drawing the quintessential downtrend. I think that 20% mark will act as a bounce point, a heavy bounce point. And I do believe that the central banks will protect the markets if we drop to 20%, like they did back in 2008. What do? They slashed the Fed funds rate 2 times in a row when we got down to that 20% mark. And the market would bounce. It even crisscrossed a little bit. It actually crisscrossed and then it went up. Let me add, great, I've got this pen on stuck mode here. It actually bounced back up higher above this. Merlin, come on. What's going on here? Why is it giving me a pen? sorry, I'm trying to draw this bounce because it would, it did this. There you go. It actually went much higher, and people are like, oh, here we go, we're back to the upside, and then came screaming back down. So I think the trigger will be once we break the 20% mark. But when it happens, if it happens, just remember, if it does break down below 20%, it'll probably do a little bit of a head fake, rip back up, and get very jiggy with regards to price action, but continue on to the downside. So that's what I think would ultimately happen for the S&P. But we got a long way to go till we get there, guys. That's to me, it's off the table at this moment in time. For me to even consider that happening, we have to get below these lows that we established a couple weeks ago. Right? We must break those. Obviously, there's no way we can get to those levels unless we break that 594 on the S&P. Now, once we break that, then we'll start looking at that next logical targets like 540 and maybe even lower than that. So it'll be just a stair-step piece down and down and down if it does get there. And I do believe we are going to stair-step lower. I don't know if we're going to get a huge break down below 20%. Again, there's just too many uncertainties out there. But I do think we're going to break this 594 mark on the S&P. Not aggressively, but I think we'll start to drift lower as the markets just kind of get weaker and weaker. Okay. Trump talks often reciprocal tariffs. Are the software exports tariffed by other countries? I do believe that we have tariffs applied to a lot of our exports to foreign countries, and that's why we're doing the reciprocal tariffs. I don't know all the numbers there, Ganesh, on the trade deficits or what's actually, or sorry, the tariff talks and what exactly is tariffed by us. I don't follow it that closely. I'm starting to follow it more because it's so relevant in current markets, but certainly if they are taxing our software, then we're going to tariff their software for sure. Bitcoin hit a new 5-minute supply. 5-minute supply. Wow, 5 minutes? Let's go through our top 10 here real quick, and I'll wrap up. Starting at the bottom, we've already talked about technology, NASDAQ not doing so well today. We had that big engulfing pattern yesterday. We followed through with another 0.63% slide on the NASDAQ. Your dollar index pretty much erased all those gains from yesterday. And again, given all of the pieces that are kind of lining up from an economics perspective and tariffs and how other countries, I think, are going to be on the hook for more spending, I think that puts the dollar in the driver's seat. And I think that we are going to see more upside in the dollar. Today was obviously a down day, 0.37%, but I do think you'll see more upside on the dollar here going forward. That means other currencies like the euro and the pound going down in value. Russell 2000, 0.4. Nothing really technical here. Same thing with the S&P. They just had a pretty significant pullback. We'll probably pause right on that 57.16 on the S&P futures, and let's see if we get a rally out of that one. Now the 10-year yield went up a little bit. I had this old level drawn on the screen here, and I just left it there. And the reason that level was there was from this consolidation back in December of 2024, right around mid-December. We broke through that one. We retested it and bounced, and then we broke it again. Those old supply levels become demand, and sometimes there's this magnetism towards it. Well, today we rallied up to the peak of that one. We got to a high point on that 10-year of 4.4%, which was one of the targets, and then sold off from there. The question is now, does that 10-year sell off a little bit more, or do we start to see the more predominant trend move to the upside? That I can't tell you. I can make arguments either way for this 10-year yield. Given the supply of bonds that's needed to service our debt, it would imply we're going to go higher. But the Doge reducing those costs. Yep. Crude oil was your bronze medal winner today. Rallied right up into that $70 mark. We had an intraday high on it of 67.43. So intraday high. I gotta get that one down there. Intraday high was 69.97. Closed at 69.92. Target for me was $70. And that's just because of this kind of rally up here on February 27th, small pause, and then fell apart. So that is right in that supply zone, which ends at about 70.50. Above that, you're now looking at a target right around 72.50. So looking good for crude oil at this moment in time. I do think you'll see a little bit of a sell-off just because we're in supply. But there's a lot of obstacles along the way here for crude oil. Bitcoin, beautiful. I love it. It looks great to me, even though the chart looks really bad because that just overall selling pressure since January. We are making slow stair step up. It feels like you're seeing accumulation, nothing rapid, nothing just shocking, but slow accumulation. And you're going to get these big price swings. Today was up only 0.56%, closing at 87,455. But the channel that we're in, going all the way back into Monday, March 11th, looks great. Love the channel. Exactly, Irish. That channel looks really good, and it feels like it's holding. So, as they say, the trend is your friend till the bend at the end. This is staying in that trend channel. So, great. And lastly, we talked about gold. All-time highs. I do think we're going higher. I think the trade talk with Trump is going to cause it to go higher. What is kind of surprising to me is, when did we audit Fort Knox? What? Did we get the report on the audit of Fort Knox? I didn't quite get that memo. Not only that, but what happened to the tapes? All the accounts that went on to the island? Where is all that stuff? Anyway, the Epstein files. Where is all that stuff? It was all big hype and talk, right? We were gonna get the inspection of the vaults. That was all big news. And then we're going to get the Epstein files. I ain't heard nothing. I haven't heard it at all. Okay, that's going to do it for me, everybody. I want to wrap up here. I just got a ton of stuff I need to get taken care of. For today's show, I want to thank Steve. Thank you for the question. Same with Scott and Michael G. If you guys have things you want me to discuss, you guys know I'm always down. I don't know everything. I don't claim to, and I may be wrong on some stuff along the way. You guys will help correct me when I'm wrong, as you usually do, and I'm okay with that. If there's something you want me to address, email it, tradermerlin@gmail.com. As I mentioned, I am going to be meeting with the designer tomorrow to talk about changing the look, the feel, everything. All these different shots, especially stuff like, this and just different set design pieces. If there's things you'd like to see, anything at all, feel free to throw it at me. I'm meeting tomorrow at about 11:45, so you've got less than 24 hours to get that to me so I can get it to my designer and talk about it. So any feedback is great. Those of you who sent in feedback, I do appreciate that. It was awesome. Thank you very much. More flowers in the background, Margaret. I'll have a flowers shot just for you. All right, guys, that's going to do it for me. Thank you so much. I hope you have a fantastic remainder of your day. Again, send in all your questions that you want me to address on tomorrow's show. I have some new graphics that I created. I'm going to talk about AI tomorrow a little bit and image creation, which is not trading related, but I think you guys might find it enjoyable. So, show my dog. All right, I'll show the puppers. He can't even make it up the stairs now. He's getting old. He's just, the gate's open. He didn't want to come upstairs today, but all right, that's going to do it for me, everybody. Thank you so much. Have a fantastic remainder of your day, and I will see you mañana.